Okay, well, hopefully you've had a chance to go through the statement of cash flows using the indirect method, and now we're going to walk through the statement of cash flows using the direct method. The difference here is under the direct method, the firm is going to classify operating cash flows by different activities like receipts from customers or payments to suppliers, whereas with the indirect method, everything was kind of aggregated together. The nice thing is the investing and financing sections of the statement of cash flows are exactly the same way, whether you're using the indirect or the direct method. Okay, so whenever you're doing a comprehensive example, again, you have to understand comparative balance sheets, income statement items, and also individual account transactions. And so what's required as far as your understanding has not changed. And just like the indirect method, you need to create a consistent and repeatable approach to attack a problem when it comes to the direct method. And again, I would always start with the cash flows from operations, then move into investing, and then move into financing. All right, so again, we're going to use the same numbers as we used with the indirect method, but we're just going to now use the direct method for the operating section. And so when you're doing the direct method, you start with each income statement item, and then you have to examine any related accounts that are on the balance sheet, and then you work with those two pieces of information and sometimes some information out of the specific transactions or additional information. But normally you're just going to be using the income statement and any balance sheet items to work your way to the cash flow related to that item. So we're going to start with the first item, which is sales revenue, and we're going to classify these cash flows as receipts from customers. And so again, we start with the income statement item and then we work from there. In this particular example, we are going to need some of the additional information. And so the big piece of that additional information is really this first one, which is that we have this bad debt expense where they use the allowance method. And so the important part of that is using that information, we can figure out how many of their accounts receivable were written off rather than collected. And that's important information to understand how much you actually received from your customers. And then the rest of the information is the same. Okay, so we have to get our beginning gross receivable. And so if you kind of notice, the beginning balance is $321, and we were told in that additional information that the allowance for doubtful accounts was $21, which means the gross receivable was $342. And so if you think about your net sales, your beginning AR, those are sales that would have been recorded in 2017 but would have been collected in 2018. And so that's why that is an increase, because it's a cash flow related to receipts from customers that is not captured in net sales. You also are going to have ending gross receivables, and so our balance is 117, and we are told that the allowance for doubtful accounts was 19, and so the gross amount of receivables was 136. Again, these would have been amounts that are recorded as part of sales revenue but have not yet been collected. And so we have to subtract them from the net sales number in order to get the cash flow that we received from our customers. All right, now the write-offs account can be a little more tricky. The idea here is that you have your beginning allowance for doubtful accounts. Any bad debt expense will increase the balance in the allowance for doubtful accounts. And then if we want to know how much we wrote off, we have to subtract what we have left over in our allowance for doubtful accounts. And so a write-off decreases the allowance for doubtful accounts account in addition to decreasing the receivables account. And so we need to figure out what the impact of the write-offs are, because it's a decrease to our receivable that did not result in a cash flow. And so we need to make sure that we subtract that off of our receipt from customer number. And so the beginning balance for the allowance for doubtful accounts was 21. The bad debt expenses on our income statement, it's 23. And the ending balance, we were told, was 19, which means that our write-offs were $25. And so those are subtracted from net sales in order to get our operating cash flow, our receipt from customers. We also have unearned revenue. Beginning unearned revenue needs to be subtracted because that's cash we would have received in 2017, but it would have been included in sales revenue in 2018. Similarly, ending unearned revenue are cash that we received in 2018 that will not be recorded as revenue until 2019 or potentially later. And so our total receipts from customers is $3,383. So now we're going to move to the next item on the income statement, which is cost of goods sold. And we're just going to call that payments to suppliers. And so we start with that cost of goods sold number, and then we look at our beginning inventory. So beginning inventory are costs that would have been included in cost of goods sold, but would have been purchased or paid for in 2017. So we need to subtract that out. At the same time, we have inventory purchases that are not part of cost of goods sold in 2018. But we still made the purchase in 2018, and so we need to include that amount in order to reconcile cost of goods sold to the payments we actually made to suppliers. Similarly, we do have to think about accounts payable, because these are purchases that were made on account. And so an account payable that existed in 2017 would have created inventory in 2017, but where payments on that inventory would have been made in 2018, so we need to include that amount. At the same time, the ending balance in our accounts payable, those are amounts that it would have been included in inventory but will not be paid until 2019 or later. And so when we total that up, our payments to suppliers is $1,567. Again, with each item, you're thinking through the income statement item and thinking about the impacts from the balance sheet as far as what might account for a difference between the income statement item and the actual cash. So now we're moving down to salaries expense. Notice we skipped depreciation and amortization, of course, because those are non-cash items related to investing activities. And so we start with our salaries expense. We add beginning salaries payable because those are expenses from 2017 that were paid in 2018. Then we subtract ending salaries payable because those are expenses that are incurred in 2018 but not paid until 2019 or later. And so our total cash payments to employees is $223. Now rent expense. Again, we have prepaid rent, so we have to consider the impacts of that account. Our beginning prepaid rent are amounts of rent that we paid in 2017, but where the expense is recorded in 2018, so we need to subtract that off. At the same time, the ending balance are payments that we made in 2018, but where the rent expense will not be recorded until 2019 or later, so we need to add that on. And so the net effect is our payments for rent were $227. And so now we have a bunch of other items, and for these next few items, there really is no balance sheet item. There could be for some, like income taxes and interest, but in this particular case, we don't see any interest payable or income taxes payable or anything like that. And so each of the items then on the income statement, since there's no accrual on the balance sheet, it means that each of the remaining items, it was a cash payment. And so our other operating expenses, we made cash payments of $34. For our interest, we made cash payments of $86, and for our income taxes, we made cash payments of $335. And so we put all that information into the operating section of the statement of cash flows. Receipts from customers, payments to suppliers, payments to employees, payments for rent, payments for other expenses, payments for interest, and payments for taxes. And we add all that up, we should get exactly the same amount that we would have gotten using the indirect method. And we do. The total cash provided by operations is $911. The other two sections, please review those in the other lecture because they're exactly the same and there's no reason to walk through them all again here. And so we have the first section of our statement of cash flows is our cash flows from operations. With the direct method, again, you have the individual items, and then you have cash flows from investing and cash flows from financing, which are in the other lecture. And the bottom section is exactly the same. You start with the net change in cash, your beginning cash, and then you calculate your ending cash, and then you list out your significant non-cash transactions.